Hey everyone, and welcome back to the channel where we demystify the complex world of finance. Today, we're diving deep into a topic that gets a lot of attention: how to borrow stocks and the mechanics of a short squeeze. And we're going to do it by focusing on a very specific, real-world example, a company called INLF Limited, trading under the ticker INLF. This isn't just theory, we're going to examine INLF's unique situation with actual data straight from our screeners. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/info card for INLF Limited, INLF. Let's get straight to it. INLF Limited, ticker INLF, operates in the industrial sector, specifically specialty industrial machinery. It's a micro-cap company, meaning it has a relatively small market capitalization. Through its subsidiaries, INLF Limited is involved in the research, development, manufacture, and sale of injection molding machine dedicated manipulator arms under the INLF brand, primarily in the People's Republic of China. They offer various products like transverse single and double-axis manipulator arms. Now looking at the recent price action for INLF show chart last 30 days, it's been a rollercoaster. Today, INLF saw a gain of plus 2.82%. Over the last 5 days, it's actually surged by an impressive plus 47.9%. But, zooming out to the last 30 days, we see a dramatic decline of minus 99.56%. That's a significant drop that provides crucial context. Share volume BAR chart. Today's volume for INLF was 3,931,000 shares, which is 1.3 times its 30-day average volume of 3,083,213 shares. So, we're seeing above average interest right now. What's cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why is it so important when we talk about short squeezes? Simply put, the cost to borrow is the annualized fee that short sellers have to pay to borrow shares of a stock so they can sell them, hoping to buy them back later at a lower price. Think of it like interest on a loan, but the loan is shares of stock. This fee is paid daily. Why does it matter? Because a very high cost to borrow indicates one of two things, or both. Either there's extremely high demand from short sellers to bet against the company, or the supply of shares available to borrow is incredibly limited. And yes, these fees can easily exceed 100% annually or even hundreds of %, especially for highly sought after short targets with scarce shares. Why this stock is hard to borrow right now. This brings us back to INLF Limited. Highlight CTB number 717.3%. INLF currently has an annualized cost to borrow fee of a staggering 717.3%. Let that sink in. Short sellers betting against INLF Limited are paying over 700% per year just for the privilege of holding their short positions. This is an incredibly high premium. Our data also estimates INLF's float, that's the number of shares available for public trading, at around 1.0 million shares. A small float like this can exacerbate borrow rates because fewer shares are available to meet borrowing demand. We also note that the shares currently available to borrow are unknown, which adds another layer of uncertainty and potential for volatility. Our internal composite squeeze score for INLF, which combines factors like CTB, borrower supply, float, and price momentum, stands at 41.0 out of 100. It's important to remember that a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the stock will decline further, and they are willing to pay a hefty price to maintain that position. Squeeze mechanics explained. So, how does a short squeeze actually work? A short squeeze occurs when a stock's price starts to rise significantly, catching short sellers off guard. Because they've borrowed shares and sold them, a rising price means their losses are mounting. As their losses grow, and especially when the cost to borrow is as extreme as 717.3% for INLF, these short sellers might be forced to cover their positions. Covering means they have to buy back the shares they initially sold. This forced buying creates even more demand for the stock, driving the price up further, which then triggers more short sellers to cover, creating a cascading effect. It's essentially a feedback loop where buying begets more buying, often leading to rapid and dramatic price spikes. Dilution risk check. One critical factor to consider when evaluating any potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. If a company issues new shares, it can significantly increase the float. This can offset or negate a short squeeze thesis because it provides more shares for short sellers to cover with, or for new short sellers to enter the market. More shares in the market means less upward pressure from short covering. For INLF Limited, we've checked for recent diluted SEC filings, things like -1s, -3s, or 424 BS in the last 90 days, and we found no recent diluted filings. This is a positive sign for the squeeze thesis, as it suggests the company hasn't recently added a large influx of new shares to the market. Recent reverse split watch. Another crucial piece of information for INLF is its recent reverse stock split. INLF Limited executed a 1-for-200 reverse stock split on July 6, 2026. That was just 21 days ago. A reverse split reduces the total number of outstanding shares and, consequently, reduces the float. It also typically increases the share price proportionally. Historically, we've observed a pattern in many microcap stocks. They often experience renewed volatility or even a price pop within about a month after a reverse split. This isn't a guarantee, and as we saw with INLF's -99.56% drop in the last 30 days, the immediate aftermath can be very tough. But this 21-day mark puts INLF squarely within that historical window where we've seen some post-split volatility emerge. It's a tendency we monitor, not a predictive rule. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, given all this, what should you be watching for with INLF? Show INLF chart with indicators first. Keep an eye on that cost to borrow. Will it remain astronomically high for INLF Limited, or even increase further? Second, monitor for any data on shares available to borrow. A shrinking supply would be a significant indicator. Third, volume. Will the volume for INLF continue to be above average, perhaps even spiking significantly beyond today's 1.3x relative volume? And finally, sustained positive price action. While the last 30 days have been brutal for INLF, the recent plus 47.9% gain in 5 days, combined with the extreme CTB and the timing post-reverse split, makes it a fascinating stock to watch from an educational perspective. Remember, for a true short squeeze to ignite, you typically need a catalyst that drives buying pressure, forcing those expensive short positions to cover. INLF Limited presents a very interesting case study for understanding how to borrow stocks and the potential for a short squeeze. With an incredible 717.3% cost to borrow, a small estimated float of 1.0 million shares, and the recent reverse split hitting that post-split volatility window, it's certainly on our radar for educational purposes. But always remember the risks associated with microcap stocks and extreme volatility. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments below what other stocks you're watching or any questions you have about short squeezes. We love hearing from you.